Good afternoon, everyone, and thank you for joining us on H Kelkar Company Limited's Q1 FY19 earnings conference call. We have with us Mr. Qtr1, Whole-time Director and CEO, Mr. B. Ramakrishnan, Head Strategy, Mr. Ratul Baduri, Executive VP and Group CFO, and Mr. Shrikant Mate, VP Strategy of the company. We will begin the call with opening remarks from the management, following which we'll have the forum open for a question and answer session. Before we start, I would like to point out that some statements made in today's call may be forward-looking in nature, and a disclaimer to this effect has been included in the earnings presentation shared with you earlier. I would now like to invite Mr. Qtr to make his opening remarks.
Good afternoon, everyone, and thank you for joining us to discuss the operational and financial results for the quarter ended June 30th, 2018. I will begin by taking you through the operational and financial highlights of the quarter, and we will then look forward to taking your questions and suggestions. We have had a steady start to the new fiscal, witnessing strong revival of demand in our base business and improved consumption pattern in the FMCG industry, particularly the domestic industry. Revenue from operations stood at 236 crores in Q1 FY19 as against 234 crore in Q1 FY18. Surge in key raw material prices triggered by supply side disruptions continued to plague us in this quarter as well. In the circumstances, we have chosen to focus on quality of earnings and then on growth in the near term. This, along with the weaker rupee, helped our gross margin to improve to 44% from 39% on a sequential quarter basis. EBITDA stood at rupees 36 crore as against rupees 46 crores in Q1 FY18. Slowdown in revenues coupled with the price increases in key raw materials impacted profitability during the quarter. In particular, we had to choose supplying to the right kind of, in terms of shortage of raw material, the right kind of product mix. Coming to our segmental performance, the fragrance division increased by 4% year-on-year to rupees 211 crore during this quarter, while the base domestic core business delivered a healthy top line and was higher by 13% over the same quarter last year. The overseas segment reported a degrowth of 11%. Supply side disruptions and slowdown in international markets apart, this is viewed in the context of the fact that we are transitioning our aroma ingredient manufacturing facility from Netherlands to India and have not been able to service the entire demand, particularly in the international fragrance arena, to the full quantity required. As mentioned earlier, unprecedented level of volatility in raw material prices resulted in subdued operating profit, stood at 29 crores as against 37 crores in Q1 FY18. Margin stood at 14% in Q1 FY19. In our flavors division, the revenue stood at rupees 25 crores, lower 21% year-on-year. Particularly with respect to orange oil, high cost increases impacted our sales in this segment. The domestic business without the orange oil grew by 25% year-on-year. The domestic business, overseas business grew by 3%. On a profitability front, the segment recorded an operating profit of rupees 4 crores with margins at 16%. Moving ahead, the company has taken measures to mitigate cost pressures, including upward revision in selling prices. We believe as the pass-through of higher costs to results, margins will start reflecting an upward bias in the coming quarters, albeit with a 1 or 2 quarter lag. Our recent acquisition, CFF, reported a healthy volume growth during the quarter, which combined with price increases and formulation development resulted in healthy revenue growth of 18% in CFF's core fragrance business. However, ongoing raw material supply disruptions also impacted their profitability. Going ahead, CFF will undertake further price increases which help stabilize profitability and margins. On the whole, we believe the CFF acquisition represents a value accretive and synergistic opportunity for us, particularly to cross-sell technology from CFF to Asian markets and as a base for our fine fragrance studio in Amsterdam. H Kelkar, through its subsidiary Teva Fragrances Industry Pte. Limited, Singapore, has acquired 66.67% of Anhui Ruban's Aroma Company, a company based in China. At the time when there is a strong global demand for tonalite and other key raw materials, this acquisition has provided SHK access to an additional manufacturing capacity, particularly in China, and coupled with this new facility which is coming up in Mahad, expected to go on stream later this year. This will help the group service the demand and particularly tide over the supply chain scenario in a much stronger fashion than competition. To conclude, the underlying fundamentals of the company's business remain robust and our customer engagement continues to be solid. The company firmly believes the current performance to be transient in nature and the medium to long-term outlook continues to remain positive. With this, I would now request the moderator to open the forum for any questions or suggestions that you may have.
Thank you very much. Ladies and gentlemen, we will now begin the question-answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handset while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We take the first question from the line of Chintan Modi from Motilal Oswal Securities. Please go ahead.
Yeah, hi everyone. So in this context of the whole, issue related to raw materials, if you can, help us understand, like in your business, which are the critical raw materials, how much that would contribute in terms of the total sourcing that you do, and where are these sourced from? I would request if you can be a little bit more specific and, give us some examples to help us understand this better.
So, I think unfortunately this question I have answered many times and I will reiterate that we are not dependent on very specific set of raw materials or key raw materials from one source or one geography. So we are as a fragrance and flavor industry consuming roughly 1500 products from around the world, and of that 500 products are the key volume materials which are sourced largely from China, from Florida, Brazil, and from petrochemical industries in both Europe, and 50% of the remaining are sourced from Indian aroma chemical manufacturers. So we have these 4 platforms. In total, out of our 100% buying, 25% by volume and value comes from alpha, pinene or turpentine derivatives, which is basically out of Florida and China as the 2 major suppliers. 25% comes from petrochemicals, which is largely BASF is a large supplier, and China and Europe are the main suppliers for petrochemical source. 25% is derived and directly coming from citrus oils, and the remaining 25% is comprising of a large number of aroma extracts, natural products, and so on and so forth. Within the 25% in alpha, pinene and petrochemical, roughly half of these products we source locally as the downstream processing happens in India. So out of our total bucket, 50% by value is purchased domestically and 50% by value is purchased outside India. But the 50% produced in India is also dependent on petrochemical and alpha pinene prices, which are a global phenomenon. Coming specifically to the disruptions that we have had, we started with the hurricanes in Florida, which have affected both the source of alpha pinene and the citrus oils in the last year in September, October. Particularly the citrus oils are seasonal and they are once a year crop, and they will be expected to be crop again in July, August this year, as we will understand what is the price and cost of these products coming through. Alpha pinene has been affected in China with a number of units being asked to close in September, and combined with the Florida shutdown of some of these plants, there has been an acute shortage of materials already in the end of September last year. when in our industry these kind of things happen in isolation, there is normally additional supply or additional capacity which is taken up by the petrochemical or other alternate feedstocks. Unfortunately, in this year and this specific scenario, there was a large incident in the petrochemical complexes in Europe, and in Malaysia, the petrochemical source which was supposed to get on stream did not start, and this meant that the additional supply which was expected, in fact, was not additional but was cut short by another 3 or 4 months of shortage. So by January, we had a situation where both alpha-pinene and products out of China and petrochemicals in production both in China and Europe were affected. In this quarter, when we looked back and we looked at Jan, Feb, March and our price increases and discussions, we factored these, we started to move the prices up and looked at our sourcing, alternate sourcing with additional quantities in India. And in February and April this year, we had a series of incidents in the Indian aroma chemical factories, which further completely disturbed and completely stopped the supplies in the month of, particularly the first few weeks of May. So this is the overall scenario. Although as an industry, as a company, we are not dependent on one or two key materials or key sources. Products like dihydromishenol or terpineol and so many others derived from alpha-pinene have been hit very severely. Products like linalool. So if I look at a volume point of view, almost 75% of the volume of our products has been affected by these force majeure events. So this is an unprecedented event which is not possible for any company to predict, nor it will be possible for us to react to this in a very short span. So we are taking appropriate price increase measures, cost control measures, and deferring capexes, utilizing surplus assets such as our additional space in the Amsterdam Center. We have already tied up for a 3-year lease. Similarly, additional office spaces have been leased out with the new growth trajectory in mind.
Sure. I think that was quite elaborative, and thanks a lot for that. So I'm done. That was only my question.
Thank you. We take the next question from the line of Jignesh Makwana from Asian Market Securities. Please go ahead.
Yeah. Thanks for the opportunity. How much price hike we took for this particular quarter?
So on an average, we've been at a 5%. So this is an average of all weighted average was a 5% increase in this quarter. Some price increases will fold in when the contract or the initial orders in hand will conclude in second quarter of this year, and in additional price increases we are in continuous dialogue with our customers to restore and to help us tide this specific raw material crisis. So it's been 4.5% to 5% average weighted average price increase for this quarter over last quarter, and we will continue to discuss with our customers to push this further to enable us to tide over this crisis.
Okay. And secondly, we have been told in previous calls that you have been maintaining good amount of inventory, and despite that, we are witnessing some pressure on the margin, substantial pressure on the margin. So if you can elaborate on that front. So despite having a substantial inventory on our books as compared to other industry players, we should have some positive impact on margins.
Yeah, so we have, if you look at analyze this, that the effects of inventory disruption began in September last year, and we did not have any impact of that in the last quarter of calendar. So October, November, December last year we had a normal business with the inventory which we had in line, and we have started to move some of the prices to the customers. The cost increases have been dramatic. They have continued to be further exaggerated, and it's in line with most estimates that we have. And we are looking at normally a basis of 2 to 3 quarter lag between cost increases and price increases. This has been exceptional year where we are seeing multiple rounds of cost increases due to various force majeure events, and our current estimate roughly is about 25 to 30% price increase over last year, or cost increase over last year on a weighted average basis. So the magnitude of the cost increase has been very high, and it has been progressive. While we have corrected for one of the first wave of cost increases, we are still lying with another 2 waves of cost increases.
Okay. And when can we expect this supply side disruption will get normalized? Can we expect by second half of this current fiscal it will get normalized and we will get back to a normal margin which we used to enjoy before this disruption?
I think it is very difficult to challenge a guess when everything will become normal and what do you define as normal. Things are getting better than they were 2 months ago, and they will continue to improve over the next 2 or 3 quarters. I don't see when they will not improve. But to understand, appreciate this in real terms, there is a seasonality particularly to the citrus and alpha-pinene feedstocks, and these products are not likely to the reaction if the prices go up or the supply disruption in the months of winter, there is no real way that the production can happen, and the recovery of these will start now in July, August, and we will only know in another 2 months if there has been sufficient recovery in terms of supply side. And my best guess is that it will take a few quarters before some level of or I would say reasonable normalcy will be obtained. We need to be bearing in mind that in terms of dollar rupee, there is an additional inflationary trend for us in terms of crude oil, petroleum products, underlying cost going up, additional pressures. So the whole scenario is difficult to say it's 3-month problem or 1-month problem because it's an industry-wide problem across the globe. It will take some time to restore. The magnitude of the disturbances is unprecedented. We have not seen this in more than 50 years of industry experience that we have collectively in our top management. We have not seen this kind of disruption in the industry.
Okay, and finally, if you can highlight where the current the shifting of Netherlands plant to the India is in the under which stage? How many molecules we already have transferred to Indian unit?
So, in terms of rather than molecule, in terms of value of business, we have already transferred 30% of the business to India over the last year. We are awaiting our Mahad completion of facility in the coming months. So somewhere between now and end of September, we should have it commissioned and ready. And second half of this year, we are very confident that the project in Mahad will go on stream and we will move almost 100% of the products from the Netherlands factory to Indian operations.
Okay. Thank you. This was on my side.
Thank you. Before we take the next question, I would like to remind participants, if you have a question, please press star, then 1. Next question is from the line of Vicky Pichapi from JM Financial. Please go ahead.
Hello, sir. Thanks for taking my question. Sir, just firstly, I just wanted to understand when you're saying that it will take 2 to 3 quarters to recover, is that recovery both on the sales and margin front, or is this just about the margin that you're talking about?
So let me reiterate firstly that on the sales demand side, there is no shortage of demand. You had to ration what demand we will cater and what demand we will not supply based on margin and availability of raw material, particularly months of May and June. As we speak, the demand side is strong. Our ability to service is back to normal, so we are able to service the demand that customers are generating. So there is no issue in the demand or the customer request for supplies. The large or the soft quarter this quarter was largely on the fact that we could not meet everyone's demand in the quarter due to raw material scenario. The second part of the question is when do we see margin? I think the demand is there, the sales will ramp up. The margin in terms of magnitude, we are talking about roughly 3 or 3.5 years inflation in less than 6 months. So we have a scenario where we will look at passing this on to the customers, talking to them, restructuring the formulations or redesigning the product solutions based with the discussion with the customer. But it will take at least 3-4 quarters before we can see the full impact of the steps that we are taking. In addition, we will need, if we have no additional inflation, no change in US dollar rupee, no change in crude oil as is where we stand, then this will play out in 2 to 3 quarters. So we need to be cognizant that there are underlying normal inflation factors which will continue to be there. So we will still have additional quarters requirement to bring it back to the same level as before. On a brighter note, our international business has seen a lot of traction in the fine fragrance business. We have already seen crore plus new business in fine fragrances out of our Amsterdam center in the first quarter alone. So that translates to about 2 to 3 million additional fine fragrance business in this year, which is at a good margin level and is least affected by the supply disruption because these are small volume, high value products which have not been severely affected.
So I'm not getting the point here. So basically you're saying that the sales impact that we have seen in this quarter can actually be rectified the next quarter? I mean, the sales growth should normalize?
Let me explain. We have a product, let's say a typical citrus fragrance where the cost increase is 30%. Now we have gone back to the customers, tried to reformulate, tried to talk to them and make some solution available to them. And that has been offered to them. People have taken that. Some customers have taken, some customers have not taken. So in some cases we have had to say no to the customer demand because we cannot take it at a margin below zero and or very low margins where we see that this raw material availability. So if I have the same 100 tons, I will sell it to the top 100 tons where I am continuing to make some margin and I am not able to service the customers at the lower end of the margin spectrum. So we have had to take out certain business on approximately 8-10 crores of business which we said no to in terms of the demand was there but we had to not supply. The other part is the going forward we have now restored. In particularly this was very acute in the aftermath of the additional incident end of April. So the first 3 weeks of May we had almost a freeze down and we were not accepting any large volume orders to ensure that we can continue to service the orders in hand. Post June we have started in Vapi the manufacture of some of these shortage raw materials. I am pleased to inform all of you that we have been able to go through this entire picture in the last 6 months without cancelling a single contract. So when we had orders in hand, we have executed all orders in hand. But we have declined to take orders in the aftermath of the post-major events. And this has been strongly felt, particularly in the month of May and early part of June. And now with our Vapi facility, we have been able to make some of these key raw materials in-house. At this point, we are also looking to have surplus which we may contract or sell to other users.
Okay. Just one more thing on the sales front. Now, if I look at the MNCs, they have actually reported, their growth, at least on the sales front, has been quite similar to what they were doing earlier.
If I look at further split of say domestic fragrance in the top 25, top 50 customers, we have done excess of 40% growth on these customers. What we have had to balance is while we are maintaining these large customers and this growth, we have had to say no to some of the smaller customers, which is the trade-off we have had to take.
a kind of, okay, fine, okay, I understand. Okay, and secondly, sir, just on this gross margin front, now the gross margin has sequentially improved a lot, around 400 with sequential improvement. Now, is this improvement actually driven by price hikes, or is the fact that 4Q is generally weaker on gross margin, so this is a normal movement that generally happens?
If you compare last quarter to this quarter, we have taken price increases. Part of that has flown in, but I think they have not been adequate to cover the full cost impact of the additional cost increases. So I don't think all of this is attributable to price increases. It's largely product mix. Particularly in flavors and exports, we have had a very strong management on margin front and looked at the best utilization of the raw material that is available. And on the domestic front, we are in continuous dialogue with our customers to ensure that we move the prices up in accordance with the cost increase and the pressures that we have. But there is a lag between when we can push it and do it. So if I look at this on a total basis, the domestic fragrance continues to be at 38-39% gross margin. We still have discussions with our customers to push it up. The rest of the business has restored back to our normal level of 50% margin, albeit at a slower growth. So we, in some core businesses, core brands, we have continued to supply, and we're discussing on the pricing. With the non-core smaller businesses or opportunistic business which is to come, and once in a while, we are looking at a scenario where we have had to say minimum price, and some of them have not accepted that. It's a matter of time because this is an industry-wide phenomenon, and people will accept the new normal.
Just one more thing on this. Is this 4Q gross margin generally seasonally weaker?
Fourth quarter gross margin generally is weaker because in a normal year, our price cycle is somewhere in January, February, and then the full impact of the price increase comes in the first quarter of the next financial. So normally the first quarter is the better margin, and then by the time we start to increase prices in the second half of the year, and then the first quarter again is a margin in a full restored basis. So this year we will see a lag in that, a different timeline, because we have taken already a margin or price increase in first half. We will need to take another one in the mid-year and probably a third one in the end of the year.
Okay, that's it. Thank you so much.
Thank you very much. We take the next question from the line of Qtr1 from Edelweiss. Please go ahead.
Yeah, thanks for taking my question. Sir, I have a couple of questions. One, considering everything plays out in a normal scenario where you'd see 2 to 3 quarters of stabilization, what kind of growth are we looking at internally, both in fragrances and flavors overall for the full year FY19, and what kind of gross margins can we expect for the full year, and what would be the exit gross margins that we are targeting by Q4 FY19?
So I don't have an exact number on the gross margin. I think we are seeing a momentum of 20% plus growth, which we see over last year in the first half, and we will continue to see improvement in the margin in the second half of this year. We have, for example, last year completed a year on roughly 45% gross margin level, fourth quarter, not last year, the third quarter last year. And today we are at 44% on total basis, which is 39 in domestic and 51 on export, because we have curtailed some of the low margin opportunistic business or trading opportunities, which are normal part of our business. And we are focused on the domestic fragrance and domestic flavor to restore margin to normal level, but it will take 3-4 quarters. So I don't have an exact number whether it's 45 in 2 quarters or 3 quarters or 4 quarters. But eventually we are planning to restore the margin to those levels. It is a catch-up game because there is additional inflation, underlying inflation, which will continue to happen. So we have sort of a 3.5-year inflation in 6 months. We will continue to have higher price increases across the board to our customers. We will always have a lag between what is the cost increases and the selling price scenario.
Right. So, but like we saw in Q1, we saw a significant reduction in sales to basically bring back the gross margins by 500 bps sequentially. So, should we expect like a flattish sales growth and margin similar, or we would be going the other way when?
No, I think this quarter we have not been able to supply everything that was the demand. So there is not a supply side or demand side issue. The margin, so it's not that we had not enough demand. We could not supply all the demand that we had.
So earlier we were
56 could have been easily 260 if we had raw material for everything to be supplied, and that's the momentum of demand continues. We have a challenge around the gross margin, which we will continue to discuss with our customers and look at better cost control to ensure that our profit line is exponentially growing on a top line growth of 15 to 18% year on year.
All right, but can we expect 15% growth this year, or it will be lower considering Q1 was flattish?
I think 15% growth over last year we should be able to do. And we are targeting a higher growth than that in terms of top line. But it is a very unprecedented scenario because of the cost changes. We will have to look at how much price increase, how much growth in volume, how does the cookie crumble with discussions with the customers. It's almost a T20 game which changes over by over. So every 2 weeks the scenario is changing. So it's very difficult to say what will happen over the full year, but we are committed to the long term. Our R&D and long term programs continue. We continue to get new wins. Every new win is in a stage where the margins are on normal basis. So as our business continues and new wins continue to come in, our margins keep improving, and we need to keep talking with the customer on the existing business, particularly on domestic fragrance, to restore the margins.
Right. And sir, our Anhui Ruban Aroma acquisition, that will be fully consolidated, or it would come as profit from associates like we report the CFF acquisition?
So the Anhui Ruban, it just happened yesterday and today. We will then discuss with the auditor in the next week on what is the exact basis. And on that basis, we will either consolidate or make it or keep it as a JV.
Okay, so this 15% growth is organic growth?
Yes, only organic growth. And in any case, what we are seeing in Anhui is most of their sale is intercompany. So even if we consolidate, I think the intercompany sale will get knocked off. So it should not affect the top line growth. It will only help us in the improvement in the bottom line.
Right, sir. And just last question, we are seeing cash flow from investing of about 220 crores and capex of around 121 crores. So could you just give me a split of what has been the spending on?
So just cash flow from investing is 221.
Yeah.
So we've had basically 4 major investments in the last year. We've had basically investment in the creative fragrances and flavors in Italy, which was roughly 90 crores.
Okay.
We've had a capex in the Mahad, which was a sort of CWIP of 35 crores.
Okay.
And we've taken an employee benefit trust formation, which was at a 40 crore cost. So these are the major 3 outlay, which is roughly 160 crore. And the remaining 20-30 crore is a normal capex within operations with infrastructure, building development, and so on.
Right. So this doesn't include the Anhui that will be paid in FY19, right?
That's right.
Okay. Thank you.
Advance was paid to Anhui. There has been some small amounts of advances paid on various other transactions and other strategic initiatives which are not able to comment or report specifically till the deals are either done or not done. So there are some advances in the capex line. So generally, these are the big ticket 390 in CFF, 40 for the employee benefit, and 35 to 40 crores in the Mahad investment. In addition, we had the 15 crore on the acquisition of the Mahad facility.
Okay, understood, sir. Very thankful.
I just want to comment on the capex. Most of these capex are all going on stream within the next 45 days and will be fully operational in second half of this year. So all the benefit of these large investments will start to flow in. We have been also investing in solar energy in all our plants last year. Much of the investment benefits will start flowing post the rainy season, when we expect to have almost 80% of our electricity energy cost in the fragrance division coming out of the solar generation.
Okay, thank you. That's great, sir.
Thank you. This is a reminder to all the participants in the conference. If you have a question, please press star followed by 1 on your touchtone telephone. We take the next question from the line of Nishna Payani from Prabhudas Lilladher. Please go ahead.
Yeah, good afternoon, sir. This is Ajay Bodke from Prabhudas. So for FY19, what is the capex outlay that the company has in mind?
So FY19, apart from the Mahad, the Anhui acquisition and the Mahad completion of project, which should be another 20-30 crore, and Anhui of 18 point something, so 19 odd crore. We don't see any large capex outlined for this year. In fact, we have started to lease out some of the additional infrastructure in this year based on the revised profitability. We are cutting down on some of our longer term investments. In particular, Amsterdam, we have already agreed to lease out 1 floor out of the 3, which was the Fine Fragrance Studio. So one of those we have reduced in terms of operations. We've also leased out one of the floor in the Mulund office. So these are all steps we are taking in terms of cost control and deferring capex and better asset utilization.
So in the presentation on slide 6, you have mentioned about, and you just alluded to the fact that your Mahad facility, the capex should come on stream in the next 45 days. And about the acquisition in China. So if you could just throw some light on that, the acquisition in China, what kind of benefits you see over the medium term?
Just to reiterate, our Netherlands facility we have relocated and in the process of relocating majority of the products to Indian operations, including the investment at Mahad. While doing so, given the magnitude of supply chain disruptions, we thought it is prudent to have an additional manufacturing location in China to ensure and to propose to our customers multi-location, multi-country supply chain. So we have had that as a longer-term strategy. Currently, where the prices and the supply chain disturbances, we have decided to invest that ahead of the curve and take that opportunity of having a presence and an operating plant in China to allow us to further streamline supply chain in the ingredient business or ingredient supplies for the fragrance and flavors. Specific to Mahad and Anhui combined with these 2 plants, we have enough capacity for the entire global market of these products. And if we go back in history, in various times in the last 10 years, Keva has been almost sole producer of these products. And we see that we have great strength in the product knowledge, in the quality and the brand and relationship with our customers in these products on a global basis. And we still retain almost 80% of the market of these products, and we continue to be active player with a dominant market share in these products.
So lastly, over the medium term, Does the company internally have any return on net worth targets?
I think the return on net worth targets would be in excess of 15%. We
Thank you.
look at the ROC in excess of 20% for all our investments.
Thank you very much, sir.
Thank you. We take the next question from the line of Sanket Sanghi from Ajkan Global Services. Please go ahead.
Good afternoon, sir. So my question is, sir, what is the current order book value that we see for the current quarter and even for the year, sir?
I don't have the exact, so these are not contract orders on a longer basis. We are seeing a normal flow in excess of 20% over quarter last year.
Excess of 20% growth.
Yeah.
Okay, sir. Okay, sir. Thank you, sir.
Thank you. Well, that seemed to be the last question for today. I would now like to hand the conference over to the management for their closing comments.
Thank you. I hope we have been able to answer all your questions satisfactorily. If you need any further clarifications or would like to know more about the company, please feel free to contact our team or CDR India. Thank you once again for taking the time to join us on this call.